On February 9th, 2026, something unprecedented happened in the silver market that most people completely missed. While everyone was focused on price movements and technical charts, the CME Group quietly launched a new type of silver futures contract. A 100-ounce contract that looks harmless on the surface, maybe even helpful for smaller traders. But buried in the fine print is one phrase that changes everything. Financially settled, not physically delivered, just cash. And if you understand what that really means, you'll realize the entire silver market has been built on a foundation that's starting to crack. The banks have been telling us one story for weeks, but their actions today tell us something completely different. What they just did reveals more truth than anything they've said in the past 6 weeks combined. Before we go deeper into this, if you want to stay ahead of what's really happening in precious metals and financial markets, make sure you're subscribed to Element Axis. We cut through the noise and bring you the real picture. Hit that subscribe button now because what's coming in the next few weeks could reshape how physical assets are valued globally. Let me walk you through exactly what happened and why it matters so much. For the last month and a half, every time silver prices spiked or questions about supply came up, the official explanation was always the same. Market correction, speculation, profit-taking, natural volatility after a big run-up. Chinese traders getting too aggressive with leverage. Notice what was never mentioned? Physical shortage, supply constraints, delivery problems. None of that entered the official narrative. They kept pointing fingers at speculators and momentum traders, anything to avoid discussing whether there's actually enough metal to meet demand. But think about this logically. If silver supply was truly abundant, if there were warehouses full of bars ready to be delivered, if physical availability wasn't an issue at all, why would you create a brand new futures contract that specifically avoids physical delivery? The existing 5,000-ounce contract has worked fine for decades. It requires actual metal to change hands. Real silver gets moved from vaults to buyers. That's how commodity markets are supposed to function. So why introduce an alternative that settles only in cash? The only rational explanation is that delivering physical metal has become problematic. When you can't fulfill delivery obligations with actual silver, you create an escape hatch, a way to settle contracts without touching any real metal at all. The timing here is what makes it so revealing. We're exactly 18 days away from February 27th, which is the first notice day for March delivery contracts. That's when traders have to commit. Either roll their position forward to a later month, close it out entirely, or stand for delivery and actually take possession of physical silver. And the CME launched this cash-settled alternative right now, less than 3 weeks before that critical deadline. That's not a coincidence. That's preparation. They're building a safety valve before March delivery potentially exposes just how tight physical supply really is. Now let's talk about what we've been hearing versus what the physical market is actually showing. Remember when silver hit $121 and then dropped hard? The explanation was simple, right? Overheated market cooling off, leverage getting flushed out, totally normal price action after a parabolic move. And the reassurance that came with it was that physical premiums would normalize soon. They always spike during volatility, we were told. Once things calm down, premiums come back to normal levels. Just be patient. Well, here we are weeks later, and silver has swung from 121 down to 64 and back up to around 81. Massive volatility. The kind of swings that should shake out weak hands and reduce demand pressure. Yet physical premiums haven't normalized at all. They've stayed elevated. In some cases, they've actually increased. Right now, if you want to buy American Silver Eagles, you're paying spot price plus somewhere between 12 and 15%, sometimes even 18% depending on the dealer. Canadian Maple Leafs are running 12 to 15% over spot. Even generic rounds and bars are carrying 8 to 12% premiums. Compare that to normal market conditions, where premiums typically run between 2 and 4%. That's the historical average. The markup you'd expect to cover minting costs, distribution, and dealer profit. But 15 to 20%? That's not normal overhead. That's scarcity pricing. That's what happens when dealers can't easily restock their inventory. When the U.S. Mint is rationing allocations and pushing delivery dates into late February or March. When wholesalers have backlogs and national mints around the world are running behind on orders. If you appreciate this kind of analysis and want to see more of it, go ahead and hit that like button. It helps more people find this information, and frankly, more people need to understand what's actually happening in these markets right now. Let me show you something even more telling. Over in Asia, physical silver trades on the Shanghai Gold Exchange at prices consistently between $85 and $90 per ounce. Meanwhile, the paper price on Comex today is around $81. That's a premium of roughly $5 to $9, and about 7 to 11% higher than the official futures price. Shanghai isn't trading collectible coins with numismatic value. This is refined bullion, the same purity and specifications that Comex uses for delivery. Yet it's commanding nearly 10% more because participants in that market demand physical settlement. They don't trade paper promises. They want actual metal in their possession. And when supply is genuinely tight, physical commands a premium. That premium reflects real supply and demand dynamics, not the inflated open interest of a fractional reserve paper market. India tells a similar story. Physical premiums there have been running 7 to 10% over Comex pricing, spiking even higher during culturally significant buying periods. Indian buyers have a generations-long relationship with precious metals. They accumulate physical gold and silver as stores of wealth, and they're willing to pay above the so-called spot price because they understand that paper prices do not reflect true scarcity. The fact that these premiums have persisted for 6 straight weeks, even through massive paper price volatility, tells you that the physical market and the paper market are operating in 2 different realities. Here's where it gets even more interesting. During last week's price crash, when paper silver got absolutely hammered from $90 down to $64, did physical premiums compress? Did dealers drop their prices because silver was supposedly cheaper? No. Premiums actually widened. Coins that were trading at spot plus 12% went to spot plus 15%. Bars moved from spot plus 8% to spot plus 10%. Think about what that means. Paper traders were panic selling, getting margin called, liquidating positions in a desperate rush to cover losses. But physical holders? They didn't budge. They held onto their metal. And physical buyers saw that crash as a buying opportunity. They stepped in and scooped up whatever inventory they could find. The paper market was flooding with sell orders, while the physical market stayed tight. That divergence is proof that these are fundamentally different assets operating in different supply-demand environments. You can print an unlimited number of paper contracts. There's no real constraint on how many futures positions can be opened as long as margin requirements are met. But you cannot print physical silver. You can't conjure it out of thin air. It has to be mined, refined, fabricated, and delivered. And when the primary source of refined silver, which is China, implements export controls and restricts 60 to 70% of globally traded supply, the physical market gets tight. Really tight. Yet the paper market can still trade hundreds of millions of ounces that don't physically exist anywhere. Let me paint a picture of what the inventory situation actually looks like, because this is where the numbers get uncomfortable for anyone defending the current system. Comex reports silver inventory in 2 categories. Registered inventory, which is metal that's supposedly available for delivery against futures contracts, and eligible inventory, which is silver stored in Comex vaults, but not designated for delivery unless it gets converted to registered status. As of early February, Comex is reporting around 130 million ounces in registered inventory. Sounds like plenty, right? More than enough to cover March delivery obligations? Except that number is deeply misleading. If someone demands delivery, metal can be sourced from global markets quickly and efficiently. Refiners, dealers, other vaults, there's always liquidity. As long as that assumption held, fractional reserve paper markets could function without anyone questioning whether the metal actually existed. But China shattered that assumption overnight. By controlling the majority of refined silver supply and restricting its availability, they made it impossible for Western buyers to source metal at any price in the quantities they needed. You can't buy what isn't being sold. You can't access supply that's locked behind government licensing. Now, if Comex faces delivery demands it can't meet, where does the metal come from? Mexico, Peru, Canada, Australia, they all produce silver. But their combined annual output is less than 200 million ounces, and most of that is already committed to industrial users under long-term contracts. There isn't a massive surplus sitting around waiting to rescue Comex. So Comex is trapped. They can't deliver at scale. They can't source replacement metal from China. They can't admit the problem without destroying confidence in the entire futures market. So what's the solution? Create a cash-settled contract. Build an escape valve. Hope enough traders accept paper instead of demanding metal. That's the play, and today's launch proves it. But China's move wasn't just about silver markets. It's part of a much larger strategy around de-dollarization and shifting global commodity pricing away from Western control. China watched what happened to Russia. Swift sanctions, asset freezes, reserves confiscated. They learned that holding dollar-denominated assets carries geopolitical risk. So the alternative is physical commodities, resources that can't be frozen or sanctioned or seized remotely. Gold, silver, copper, rare earths. China has been quietly accumulating all of them, not through official announcements, but through trade flows and market behavior that's visible if you know where to look. Silver is particularly strategic because it's both a monetary metal and an industrial commodity. It has the store of value characteristics of gold, but it's also absolutely essential for modern technology. Solar panels, semiconductors, electric vehicle batteries, medical equipment, water purification systems. You can't build any of that without silver, and China is the world's largest manufacturer of all those products. So by restricting silver exports, China ensures domestic supply for its own industrial base, while simultaneously putting cost pressure on Western manufacturing and exposing the vulnerabilities in Western commodity markets. And here's the long-term play. If Comex defaults or loses credibility, price discovery shifts away from New York. It moves to physical markets, Shanghai, India, the Middle East, markets outside Western financial control. And those markets can price silver in yuan, or in gold, or in baskets of commodities, anything except dollars. That's the de-dollarization endgame. Break dollar-denominated commodity pricing. Shift control over essential resources to non-Western markets. Create alternative payment and settlement systems. Silver is a perfect vehicle for this strategy because it's essential, supply is constrained, and the current pricing mechanism is a fractional reserve paper market that's highly vulnerable to supply shocks. So we're sitting here 18 days away from a moment of truth. February 27th, first notice day. And there are really only 3 ways this plays out. First scenario, smooth rollover. Open interest declines steadily over the next few weeks. By February 26th, only the usual 2% or so stand for delivery. Comex delivers around 10 million ounces without any drama. March passes quietly. The paper market survives. Banks breathe a sigh of relief, and the system continues as it has been. Honestly, I'd put the probability of this outcome pretty low, maybe 20%. The fundamentals just don't support it. Supply is constrained, inventory is draining, premiums are elevated. Too many participants have reasons to demand physical delivery instead of rolling forward. Second scenario, controlled crisis. Open interest stays elevated. Maybe 8 to 12% of contracts stand for delivery instead of the usual 2%. That's 80 to 120 million ounces of demand. Comex manages to deliver maybe 50 or 60 million ounces to priority clients, but they can't fulfill everything. So they implement a partial forced settlement. Contracts above a certain size get cash settled at a slight premium to the settlement price. Some traders accept it, others file lawsuits. There's media coverage. Credibility takes a hit, but Comex survives. They delivered to the most important customers, forced cash on the rest, and they point to the new cash-settled contract as proof they're adapting to market needs. Physical premiums spike to 25 or 35%. The gap between paper and physical widens even further, but the paper market limps along. I'd say this scenario has maybe a 50% probability. It's the muddle-through outcome, messy, uncomfortable, but not a total collapse. Third scenario, full default. Open interest stays high. 15 to 20% of contracts stand for delivery. We're talking 150 to 200 million ounces of demand against maybe 60 to 80 million ounces of deliverable supply. Comex simply cannot fulfill those obligations. They don't have the metal. So they're forced to cash settle everything. Every March contract gets closed out at the February 27th price. No physical delivery at all. Comex admits they couldn't meet demand. Lawsuits fly. Congressional hearings get scheduled. Regulatory investigations open up. Trust evaporates. Traders abandon Comex entirely. Price discovery shifts completely to physical markets and direct transactions. Physical premiums explode to 50% or more. Silver might hit $150 or $200 in physical markets, while the paper market ceases to function as a credible pricing mechanism. Right now, I'd put this scenario at maybe 30% probability and rising. If we see certain patterns over the next 18 days, elevated open interest, accelerating withdrawals, widening premiums, that probability goes up significantly. The key variable is delivery intentions, and we won't know the real number until February 27th, but behavior between now and then will give us clues. If traders are aggressively buying physical, if withdrawal rates accelerate, if premiums surge even higher, that telegraphs chaos ahead. And for anyone holding physical silver, the message is pretty straightforward. Your position is validated, the shortage is real. Today's cash-settled contract launch is an admission of that. Whether March unfolds smoothly or chaotically, whether it's a controlled crisis or an outright default, the value of physical metal is higher than paper prices suggest. So here's what to watch over the next 18 days. Track March open interest daily. If it stays elevated above 90,000 contracts heading into late February, that's a warning sign. Monitor registered inventory. Any large withdrawals, anything over 5 million ounces in a single day, or sustained multi-day drains, that's significant. Watch physical premiums in North America and Asia. If they widen further from current levels, that confirms the shortage is intensifying. Keep an eye on the forward curve. If March contracts start trading at a significant premium to May, that's backwardation, and it signals deep distrust in future delivery capability. Pay attention to mainstream media coverage. If the story starts breaking into broader financial news, that's when public awareness accelerates and demand could surge. And watch for how quickly the new cash-settled contracts gain traction. If volume stays low, it means the market is rejecting the paper alternative and demanding real metal. This isn't speculation, This isn't conspiracy theory. This is just following the logic of what's actually happening. Banks told you there's plenty of silver, but they just launched a contract that avoids physical delivery entirely. They told you premiums would normalize, but premiums have stayed elevated for 6 straight weeks and are rising. They told you inventory is sufficient, but the math doesn't support it when you account for how much metal is truly deliverable versus just listed as registered. They told you paper and physical are equivalent, but they're trading at completely different prices in markets around the world. 18 days from now, we'll have a much clearer picture of just how deep this problem runs. Until then, watch the indicators, ignore the noise, and understand that what you're witnessing is a slow-motion unraveling of a system built on assumptions that no longer hold. Physical silver is scarce. The paper market has overpromised, and March delivery is the moment when those two realities collide. Registered doesn't mean the metal is sitting there ready to load onto trucks tomorrow. Some of it is in transit. Some is tied up in legal disputes or ownership claims that haven't been fully resolved. Some of it is already allocated to prior delivery obligations or forward contracts or lease agreements. The actual amount of unencumbered, immediately deliverable silver is substantially lower than the reported registered figure. Industry analysts who've tried to track this closely estimate the truly deliverable supply is somewhere between 60 and 80 million ounces, maybe less. And some of that metal doesn't even meet the exact bar specifications required for Comex delivery without being re-refined, which takes time and money. Now compare that deliverable supply to the demand side. March open interest as of last Friday stood at over 101,000 contracts. Each contract represents 5,000 ounces. Do the math, that's more than 505 million ounces of notional exposure. Historically, about 98% of futures contracts get closed out or rolled forward before delivery. Only around 2% actually stand for delivery and demand physical metal. If that historical pattern holds, you'd be looking at roughly 10 million ounces of actual delivery demand. No problem. Comex could easily handle that. But this isn't a normal March. This is March 2026, coming 6 weeks after China locked down the majority of Western silver supply. 4 weeks after, Comex saw the largest single-month inventory withdrawal in its history. 2 weeks after a historic price crash and rebound that left serious questions about the integrity of the paper market. So what happens if more than 2% stand for delivery this time? What if it's 5%? That would be about 25 million ounces. Tight, but probably manageable. What if it's 10%? Now you're at 50 million ounces, which would drain most of the available deliverable inventory. And what if it's 15 or 20%? At 20%, you're talking about 101 million ounces of delivery demand against maybe 60 to 80 million ounces of truly deliverable supply. That's a shortfall. That's a default scenario. And the problem is, Comex won't know how many contracts are standing for delivery until it's too late to do anything about it. First notice day is February 27th. By the time delivery intentions are locked in, if the demand exceeds the available metal, there's no time to source additional supply. China controls the export pipeline. Licensing takes weeks. You can't just call up a mine and have them ship extra tons overnight. Drop a comment below if you're following this situation closely. I'm curious how many of you are watching March delivery as closely as I am. Are you holding physical? Watching from the sidelines? Let me know. This is the crisis that today's cash-settled contract is designed to solve. Can't deliver your March contract because there isn't enough metal? No problem. Roll it into one of these new 100-ounce cash-settled positions. No physical silver required. Just cash changes hands. Comex stays solvent. The banks avoid default. The fractional reserve game continues, but there's a major flaw in that plan. It only works if traders actually accept cash settlement as a substitute for physical delivery. And there's growing evidence that a significant number of participants won't. Think about industrial users, companies that manufacture solar panels, electronics, medical devices, batteries. They need physical silver. Their production lines require actual metal. They can't build products with cash. If they have hedged their silver needs through futures contracts and Comex tries to cash settle instead of delivering metal, those companies have a serious problem. They'll have to source physical silver somewhere else, probably at much higher prices in premium-heavy physical markets. Some of them won't accept that. They'll demand delivery as contracted. And if Comex can't provide it, those industrial users will never trust Comex again. They'll go directly to mines, set up private supply agreements, or buy exclusively from Asian exchanges where physical delivery is guaranteed. Then you've got sovereign entities and central banks. Some governments and wealth funds have been quietly accumulating silver as part of reserve diversification strategies. They're moving away from over-reliance on dollar-denominated assets. They want tangible commodities they control in vaults within their own jurisdictions. If they're holding March contracts expecting physical delivery and Comex offers cash instead, they're not going to shrug and accept it. They want the metal. They need the metal for strategic reserves. Cash settlement defeats the entire purpose of their position. And even among retail investors, there's a subset of people who have been stacking physical silver for years. They understand the game. They know the paper market is leveraged far beyond available supply. They know cash settlement is how the system avoids accountability. So if they're holding March contracts and have the capital and vault access to take delivery, some of them will absolutely stand for delivery. Not to flip it for quick profit, to own the metal, to prove the shortage exists, to force the system to admit it can't meet its obligations. That's what terrifies the banks. Their entire business model depends on the assumption that 98% of contracts settle without delivery. They run a fractional reserve system where 1 ounce of physical backs dozens of ounces of paper claims. As long as delivery demand stays low, the illusion holds. But if delivery demand spikes, even modestly, the system breaks. If this kind of content is valuable to you, make sure you share it with someone who needs to hear it. A lot of people are getting bad information right now, and the more who understand what's actually happening, the better. Let me explain what January's withdrawal numbers actually mean. Comex lost 33.45 million ounces of registered inventory in a single month. That's the largest monthly drawdown on record. Think about the behavior that represents. Traders aren't waiting around to see if March delivery happens smoothly. They're pulling metal now, rolling into earlier contracts, paying premiums for immediate possession, doing whatever it takes to get physical silver out of Comex vaults and into their own control. Why? Because they don't trust March delivery will actually happen. They've seen the export restrictions, they've watched inventory drain, they've seen the premiums in physical markets, and they've concluded that getting metal now is worth more than holding a paper promise for March. There's also something called backwardation that started showing up in January. Normally, futures contracts trade in contango, meaning later delivery months cost more than near-term months. That reflects storage costs, financing costs, the time value of holding a commodity. But in January, silver futures went into backwardation. Near-term contracts became more expensive than later ones. That's unusual, and it signals something specific. It means market participants value immediate physical possession more than future delivery promises. They're willing to pay a premium to get silver now rather than wait. That's fear. That's distrust. That's the market saying we don't believe the system can deliver later, so we want it now while we still can. The banks heard that message loud and clear. That's why they orchestrated a massive liquidation event, dumping 425 million ounces worth of paper contracts in the span of 10 days, forcing margin calls, triggering stop losses, crashing the price from 121 down to 64 to shake out leveraged longs and reduce delivery pressure. And it worked to some extent. A lot of speculative positions got wiped out. But even after all that forced liquidation, March open interest is still sitting above 101,000 contracts, still representing more than 500 million ounces notionally, still massively above the available deliverable supply. The problem didn't go away, it just got temporarily masked by price manipulation. And now, with 18 days left until first notice, the pressure is building again. Well, let's zoom out and look at the bigger strategic picture here, because China's role in this is absolutely critical. On January 1st, 2026, China implemented export licensing requirements on silver. Not an outright ban, just controls. Only 44 companies qualified to export. They had to meet certain capacity thresholds, maintain significant credit lines, and get government approval for every single shipment. On paper, it sounds bureaucratic. In practice, it cut off 60 to 70% of the refined silver that Western markets had been relying on. And that move was checkmate for the Western paper silver market. For decades, the system operated on one foundational assumption. Physical silver is always available at current prices.